Morning. Here are the three things that you need to know this morning. First things first, the yield curve, or at least part of the yield curve, has inverted for the first time since 2006. And we're talking about specifically the gap between the 5-year Treasury note and the 30-year Treasury bond. Now, the spread that we most frequently watch is the 2-10 spread. Jay Powell, in his most recent testimony before Congress, talked more, and in his and his press conference as well, talked more about the shorter end of the yield curve. This goes to the longer end, but it did invert. What does inversion mean? It means that the difference between these two is now negative, went past below zero and is now negative. And this basically indicates that folks are estimating that we are going to see the Fed not be able to necessarily catch up with what's going on inflation-wise, potentially trigger a recession. Here you see the that spread in real time, right? The 30-year yield right now at 2.56%. So it's backed off a little bit from where we saw it in earlier trading. But Brian Sozzi, the bottom line here is, what does this indicate? What does it forecast? In the past, it has forecast recessions, but there's a lag, and it doesn't necessarily mean that stocks are going to be selling off right away. And indeed, today, we're not seeing them sell off.
Yeah, Julie, I think for the average investor out there, hearing a potential yield curve inversion is wonky gibberish. If you are a new investor, all you really have to know right now is anytime you hear yield curve inversion, you probably want to start worrying about a recession. Now, JP Morgan is out with an interesting note here this morning saying recessions don't typically start ahead of the yield curve inverting. To your point, you could see a lag here, according to JP Morgan, of close to 2 years. They are noting that the clock has not yet started on a potential recession watch because the yield curve has inverted. In fact, Julie, they're even adding that stocks could outperform relative to bonds as we all sit here and worry about this inversion.
Yeah, well, there's so much. It's one of these things where there's so much talk about it as well that when it actually happens, sometimes you see the effect a little bit less because we have been anticipating it. So we'll see now how it plays out.